Hey everyone, this is Jonathan Mallard, and we'll get started here in just over 15 minutes. Anne-Marie will be joining us shortly. And yeah, good to see everyone tuning in. Get out your pens and paper, or whatever you're using to take notes, because this session on how to trade and grow your portfolio with options for dummies should be a great place to start for those of you who are beginners, so you haven't been doing this for a while, or you're new to options. Just different ways to wrap your mind around options trading and how to do that in a responsible way that will protect your account. So let me know where you're tuning in from. I see Akjim from Alaska. Welcome Brett Stevens to the YouTube channel. And I see Charles and Claudine and William. So thanks for being here. We'll get started in a few minutes. All right, who's ready to get started in here? Let's see in the chat, where are y'all tuning in from? I see Chase, welcome, Wokeman. I've got Warren, William, Towlin, Shanna K, Pete, Penny, Mario, Margot. Awesome, Egypt. I always love seeing where people are tuning in from. We get listeners from all over the world. You should have access to the chat either in Zoom or on YouTube. And today we're going to be covering basically where to start with options. And we're going to give you some visuals of how to think about options using something called risk profile. And so you'll see what a simple call or a simple put looks like, and then what happens to the risk of the trade, as well as what you can make off of the trade when you add in some more, they're called legs of the trade, when you add additional portions. So Anne-Marie is here. She's really the expert. I'm the hype man. My name's Jonathan. And it looks like we had a little pullback this morning on the SPY. So how can we make sense of that? How does that affect our trades? And how can we move forward to be profitable, but then also to cover our downside risk? Margot tuning in from London, Elijah from Miami, Luz from Pennsylvania, another Midwest guy, and Central New York, Costa Rica. Fantastic. And Anne-Marie, you're here, right?
I am.
Awesome. I'll get rid of this soundtrack thing so we can hear ourselves talk. How's that?
Great.
And do we have video for you today or no video?
Absolutely. Absolutely.
I'll stop sharing my screen.
I'm in my husband's office today, so I've got the background kind of faded.
Nice. I always like doing these from Benzinga HQ in Detroit because I feel so cool with these neon lights. way cooler than I actually am. But I've got NFTs and stuff in the background, like I know what I'm doing with those. Cool. So how are you? You're just back from Hawaii, right?
I am. It was a great trip. It was a great trip. It went a little fast, but all good holidays go fast.
Right. I don't know how a trip to Hawaii could ever feel too short, right? I mean,
yeah, that part is true. That part is true.
Always feels short, but so yeah. Do you just want to introduce? I mean, I know you. I know how good you are at trading, but maybe just for people who aren't familiar with you.
Absolutely. Well, everyone, thanks again for taking the time. You know, there are a lot of things that you could look out in the market to and go to study from. And we're really glad that you chose us. And I'm really glad that you're here to learn about the option space and how I look at it and how the market happens to tell me a particular story across time. So I've been trading for about 20 years. And I've written a couple of books, and so I've been around the block for a few times, and I really trade to eat. And so that's my favorite thing to be able to express to folks, that really the proof's in the pudding, because when I share trades, it's really what I'm doing, and you'll be able to see the risk and reward associated with that every time you look at me do a particular trade. And so I'm here with Benzinga doing these options master classes that will be available for us in the short term on the open framework here, and to share with you a little bit on what's behind in the platform on Benzinga Pro. And so what I'd love to do is show you how I look at the market to tell me what's happening from day to day. And so I'm going to share my screen, and let's use this one. Okay, I'd like to know that you can see my Thinkorswim platform. Yes. All right, fantastic. And so here's how I look at something and say, all right, what's going on? And so I have a monthly SPY chart and then a weekly SPY chart. So the monthly is here. The weekly, I'm going to use a spotlight. Hang on 2 secs. Let's do the annotate. Let's use the no, I like the invisible. I like no, I like the invisible pen. This is the monthly, and this is the weekly. This is the daily. This is the 4-hour. This is the hourly, and this is the 15-minute. And so today I began the day looking at price action that really appeared to be fairly bullish because we were sitting on top of these lines and the price action has broken down on us and it continues to break. So one of the things I anticipated was a motion back to the upside, and it hasn't come together. And so I get very excited when I get to talk about places where, hey, this is what I thought was going to happen, and then here's what really happened. Sometimes I'm spot on. Other times I'm not. And so this is one of the mornings I came in and said, listen, I suspect, let me move this button back to my mouse so I can close that. What I expected was not what transpired. And so this morning, we're looking at something this midday. We're looking at something that's a little bit different. But every day, no matter what, this is how I start the day. And I would suggest that you do that also, that you look at what the monthly charts are telling you, what the weekly charts are telling you, and what the daily and 4-hour charts might be telling you, because they're going to help you determine what you want to do, particularly around the option space, which is where we are going to sit. So what Jonathan and I wanted to do this morning is take a look at something called a risk profile that appears on the Analyze tab in Think or Swim. And so I am going to
Just while you're pulling this up,
Uh-huh.
I want to encourage the beginners here, just stick with us, okay? Because I know this can look a little intimidating at first, like just even seeing the option chains on Thinkorswim. But the reason why I wanted to do this is I really think if you stick with us today, you're going to come away from this session having a much more concrete understanding of why some options are actually safer than owning a stock. Or, so that's really what, just stick with us, okay? I know it can look intimidating, but we'll do our best to explain everything step by step, and definitely use the chat, for questions. And David, we should be on here. Anne-Marie should be on here for about an hour, and then I'll stick around for another half an hour after that. And then Shah was asking how many screens you're using.
Okay, so today, because I'm actually in my husband's office, today I only have 2 screens. Normally I have 4, but many times when I'm traveling, like I was in Hawaii for the last several weeks, I really had only 1. So the question becomes, what do you want to look at, and how many eyeballs do you actually have, and how are you going to use those? And if you're like the normal human, you've just got 2. And so sometimes it's good to bring your focus in rather than expanding it out. So here's what we're going to do. We're going to go to our risk profile tab. And what the risk profile says is, if you're right, it's going to do this. And if you're wrong, it's going to do this. So we need to get this fixed because it's not quite right. So let's go to 107 and see if it'll reset itself. It's not reset itself yet, and that's because I know what a risk profile is supposed to look like. There we go. So today the market is moving down. And so I have highlighted here, and I'm going to write this with my not disappearing pen. I'm going to write, for heaven's sakes, how do you write? Okay, we'll do a text. We'll do text and we'll do it in this color. What we are looking at is the spread, not the spread, the single, the SPY 407 put that costs $1.13. Okay, now every time you buy an option, it gives you control of 100 shares. So anytime you see the price of a standard option, you're going to multiply it by 100. And so your total cost will be $113. Okay? Forgive me, I have another platform behind me. And so let me shut that platform down right now. Hang on 2 seconds. Close all windows. Let's see if it closes. All right, so what this is a SPY put. Now, when the put gets bought, it means that low prices, which will always be to our left, lower prices will always be to our left, higher prices will always be to our right when you're looking at a risk profile. So when you buy the SPY 407 puts, if you buy one of them, it's going to cost $113. Well, the price action keeps going down. And so what we have here is this now being worth $119. So if you bought it just about 3 minutes ago, you would be up $6, $7, okay? Because now it's going for 120 or so. Well, what it tells you when you buy the SPY, and I'm going to, whoopsie, I'm going to make this word a buy, right? When I buy that SPY 407, I am long the put. So long means I bought it. Short means I sold it. That's the only thing that those two words ever mean in the market. Buy means I bought something, and that would be long, buy, and long, two words that mean the same thing in the market. Sell and short, same words in the market, okay? So if I buy the SPY, it means if I buy the SPY puts, it means I want price to go down. And notice how this goes straight up here, all the way to 6,000, okay? Assuming that price falls off a cliff and it moves to $350 or lower. Well, that's probably not going to happen. That'd be a really scary thing if that actually happened right now. People would be very, very nervous, okay? So that being said, let's go back to my, sorry, I don't know if you guys can hear my grandchild. She is
Sounds fine on this end. And just
very
for anyone
bad.
who has trouble reading the axes, the x-axis and the y-axis, or maybe I'll wait until we get back there. Sorry if I cut you off.
Okay, no problem, no problem. So I just wanted to make sure where we were going. Okay, so yes, so what this tells us is price action is down here. You'll see 410, 420, and the writing is small. I do have that small writing down there. And so you can actually go in there right now, and it continues to go up. 113, it was a minute ago. It's now 128. It just keeps rising because price is falling. And so you pick yourself up a little bit of profit as it moves through that particular space, right? So what this tells us is if I buy something and the price goes down and I buy a put, I'm going to have increased returns. Now, this is a very cheap SPY because it actually expires today. But if I wanted to buy, let's go to, well, for heaven's sakes, that didn't shut down. Yes, I do. Hang on 2 secs. Let's close this one up. All right, here we are. If I wanted to buy the SPY June 10th, and I wanted to buy the 407, right? Same strike. Notice here, it says my total loss is how much I bought it for, right? Anytime you buy something, the total loss that you will ever take is the amount that you bought it for, okay? When you're looking at a standard spread. The second you start selling something, it opens you to a little bit more risk. So here we are. And so if I buy the 407, what I want to do is refresh, which I think are swim. Aha. Now, oh, that's a call. Sorry. Oh, this is just as well. So on the call side, here's a 407 call. And this one costs $7.24, the 407 calls. All right. So notice down here, always again, this is higher prices on the right, lower prices on the left. So when you look at a risk profile, it tells you what side you need to be on to make money, right? If you've got an upward draft, it means you're making money on that side. Notice what happens here. Do you see how it flattens out? And it goes all the way down, but then it gets absolutely flat. The most that you can lose is the $700 that you bought the 407s for. Now that's a call. Now I'm going to switch that to a put, and you're going to see how different that looks. Give the system a chance to recalibrate, as it were. Let's do that again. Used to do it way faster than this. Not really sure what's going on here. But it would normally flip around. Why isn't that doing that? Click, click, click. Well, son of a gun. All right, let me move screens and let me go back. Wow. I'm so sorry, folks. Let's see. Okay. Now, let's see what it does. Okay, so here's the put, right? And this put, notice, do you see the price compression of this motion, right? We've got, anytime you see this going upward, the risk line, it's going to show you where you're making money, right? And so see how this flattens out? Your return is theoretically infinite, but your risk is defined because this put that costs $640, the 407, that's the most that you're ever going to lose. So someone might say, well, what's this pink line? Well, this pink line is the passage of time, and it tells you how things are going to shift around, potentially where you are, and it tells you a little bit about where price action is right this minute, okay? So right this minute, it's telling you that price action is sitting right around the 0 line right here if you bought this $634 or $640 option. So when you use a risk profile, it gives you an absolute amount that you might buy or sell that shows how much real risk you have. So now I'm going to show you what undefined risk looks like. That's when we sell something and let's say we sell a naked, call. Okay, so I'm going to turn this to call and we're going to sell it. And I'm going to flip the script here and hopefully Mr. Profile will begin to move around somehow. I'm going to delete this because it's not the same anymore. Annotate, clear.
And just while, oh, there, something happened.
Yeah, there it is. It just takes a while. Go ahead. You were saying.
Well, we can come back to it. You might have already explained the difference between the green line and the red or purple line.
I just did.
Okay, I was answering some questions.
Great. Yeah, no problem. The red line is where we are right now. Okay, so take a look at this. Remember, when the line is moving up over the 0 marker right here in the middle, it tells us we're making money. So we're going to be making money either on this side or on this side. Now, because here's the 0 line. Let me do this again. Draw a straight line. No, I want to draw an arrow. Okay, so this line right here, that's the 0 line. If you're above it, you've made money. If you're below it, you've lost money. Okay, so notice what happens when you sell a naked call. Your loss is infinite. Literally, you can lose thousands of dollars as price moves up. Okay, so now if you sell a put, that same thing's going to happen if the price goes to 0, but it's not infinite theoretically. Theoretically, if you sell a call, prices can go up and up and up and up and up, and you will lose your money. Sort of like Melvin Capital, who had to shut its doors because of the meme business with GameStop. Okay, so here is this motion of price action here, and the pink line is where we are right now. So what I've done, I'm going to write this down so you can see text. I have sold SPY. What is this one? 407 calls. Right? So the 407 call I have sold, and all I can make is how much I sold it for, which is currently $200.02. So when you sell something, you immediately collect something else into your account. That allows you to collect profit immediately. And so what price action does is slip away or hold, and see, notice here, remember, as I mentioned, if we draw above this line is money that you make, and below the line is money that you could potentially lose. Okay, so if you have a naked sale, you sold it and nothing else, you could have infinite loss as price action continues to move up. Now, I'm going to show you what clear all the drawings. Okay, we're going to go back to the mouse. Now we're going to look at the sale of a put. Okay, we're going to do this. We're going to get the chart to wiggle around. It used to do this immediately. There must be so much stuff going on in the background. Let's see.
And I'll just, while that's figured out, I'll just repeat this one more time for beginners. So usually we're used to price being on the y-axis, going up and down. But just to reiterate, the price of the stock is on the x-axis, meaning left is lower price of the stock, right is higher price of the stock. And then going up and down on this risk profile, that's how much you could make or lose, depending on for each option contract or set of option contracts. I just want to repeat that lots of times because this is different from how you would normally see price on a stock chart.
Yes. So because a risk profile is very intent on sharing with you what you can win or what you can lose, you're going to look at what you win and lose being here, what you win and lose is being measured here, with this being your zero line. So anything underneath that line is loss. Anything above it is gain. So that's what you're looking at. And the price of the stock is down here, right? So as price moves, this is what happens to your balance. So right now what we're showing is the sale of a put. Now remember, when you buy a put, what you are doing is thinking that the stock is going down. When you sell a put, you think the stock is going up. And so if you think the stock is going up, what you've sold it for is how much money you're going to make. And if we sold it for $614, that's going to be what we make up here. It is the absolute most that we're going to be able to make up here is that 614. Notice it moves up and then it balances out. So this line right here, this zero spot where we are right now, tells us what's going on in this curve. And the curve is adjusting for theta, giving us the natural worth of the option at this time. The closer it gets to expiration, the more likely it is that these two lines will come right into each other. And so that is what we are actually looking at, these two particular lines here. So notice, again, if we sell the put, then what happens to our profit? And let me clear all of these, clear all the drawings. If we sell the put and price goes down, we lose money, right? The moment that it gets below this line, we're losing money. So if we sell the put and price goes down, we lose money. If we sell the put and price goes up, we make the money that we sold the put for. Okay, so that is the nature of just selling something and just buying something. Now what I want to show you is why we use a spread. Why would I want to use a spread? Well, I want to use a spread because it protects me from these very savage downdrafts. I don't want to see them. These savage downdrafts, they make me nervous. And if I have a small account and I decide I'm going to sell a call or a put, I could easily get a margin call if it goes against me. All right, so now let's go back to our simulated trades. And what we're going to do is we're going to buy a spread. And the first thing, let's not look at this week because it'll be so cheap. Let's go to the month. let's say we're thinking to ourselves, you know what? Price is going to go down. And so I'm going to delete a few of these. Let's say we're thinking that price is going to go down. So I'm going to buy a 409. But what I really want to do is hedge things so I don't lose the entire $1,000 that it costs to buy the 409 put, because that's over $1,000 right now. It's $10.12. So I want to be exposed to the 409 price. I just don't want to pay $1,000 for it. Okay. And we'll look at the same thing. Let's say we've got a bounce. We want to buy the 408 calls. The 408 calls are $900 almost. I want exposure to the 408, but I don't want to pay the $900. 825, yeah, that's right. Okay, so how might that look? Let's go to the risk profile. Okay, so it's going to have something wonky there. So let's just start with the single put for $1,000. This is going to change position. I don't know how long it takes. We give it a couple minutes. What I'm trying to show you is price is the strike is the most important thing that you can look at on your price points when you're staring down your chart. It is going to be, what price do I want to see the charts move at? And so, for heaven's sakes. All right. Well, that's very interesting. Huh. That is a very interesting profile. How much, what is the, oh, look at that. $2,000 though, that's a lot. Okay, so here we have all of these trades sitting in the profile. We have a long put, a long call, and a put spread and a call spread. Notice there are no sharp lines going down to the south, but even only having one of each of these, the most I could lose still falls into the well under the 2,000 area. It looks like about 2,200. Okay, so that's a lot of money to lose on a trade, and really the trade could be all the way, I'm going to have to make money. It's got to get above 390 or above 426 for me to even make any money by the end of the month. If you're thinking to yourself, holy cow, what is she saying? Don't worry about it. We're going to start evenly. And we're going to say, what happens if I just buy the put? Now, if we just buy the put, the 409 put for the 17th of June, it is going for $10.40 right now. Now, for goodness sakes, what is going on here? Let me shut this. I'm wondering if it is computing power that's doing this to me. There we go. Okay, so that shows me, see, a negative $1,000 and a little bit more. That's what it would be if I just bought the put. Now notice, see how this goes straight up here as price goes down? I can make all kinds of money, but it balances how much I lose. Now, the big thing that we learn in the market is there's always a risk and a reward, and the distance between the two tells us what's going to happen. Now, notice the following. See this right here? You might look at it going, wow, that looks like a lot more. But see, this is only now $160. That really it's going to be $181. That the most you can lose is $181 because I'm buying the 409 strike that I wanted exposure to, and I'm selling the 405. Why? Because I do not want this number to go down to the floorboards. I want it to be bounded. That's a math term that means it's got a railing on the side of it. It cannot go over that particular amount. So in math, we call that bounded. And so our risk is bounded by the amount that we paid for this spread, which is $1.80, okay? And so that's $180. And if the price goes all the way up, notice, see how it moves up, 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 and then right about here, it starts to flatten out. So what does that mean? It means that right at around the price of 403 to 404, this price gives you almost all of the money that you could get in the space. So 409 minus 405 is $4, right? So the most I can make is $4 minus how much I paid for the option, which was $180. So I'm going to change that number to be $5 wide, and you're going to see this bounce up another $100. It's going to move up towards you that way. One of the days last week, or maybe week before last, we had someone say, hey, price moved all the way into here. Can't I just close it out? That's what this line means. This pink line means the passage of time. So let's say this happens tomorrow and it goes all the way through, but this doesn't expire until the 17th. It's not going to give you full credit. It's only going to give you full credit at the time of expiration. See, that's what this pink line means, what's going on today. And the blue or cyan line means what happens at expiration. Okay? And so at expiration, that's what we're looking at. For maximum risk down and maximum reward up. How clear are we there?
How are we doing, everyone? David says he's learning a lot.
Okay.
B says that spreads are where they generally tend to get lost. So hopefully this is helping, just seeing that those limits there to the upside and to the downside. And then,
This is why we do it. Now, remember, there's always a give and take in the market. If you want to manage your risk, it means you're going to cap your reward. And so here's the great thing. We are now in a market formation that is not moving straight up all the time. As a matter of fact, it's moving all over the place all the time. And so we aren't sitting in a place like mid-2020 where everything was moving straight up. So at this time, it's better to bound ourselves because price is not going to move dramatically in one direction or another. It's just going to grind its way through. Okay, so keep your eyes. Remember that this one moved up here and then down here for the risk versus reward. We're going to reverse that because these are puts, right? Puts make you money when prices go down. To the left of our chart, prices are going down. To the right of our chart, prices are going up. So if you buy a put spread, you're going to lose money if prices go up. And that's why when you buy a put spread, it always looks like this. It always looks like this weird L shape or this weird S curve that slopes up to the left and down to the right. Now, take a look at what happens when we do a call. And of course, it'll take a couple of minutes for us to see this. First thing we're going to do is we're going to look at just buying the call. So notice, oh, I can also close this. That will, no, I don't want to close that. I'll close this one. All right. When we buy a call, we spend money on that call, and that call is now $9, okay? The 408 call is $9. And so again, everything is times 100. So if you buy this call and you hold it to expiration and price goes down, you're going to lose all of that money, all of it. This is where it is right now at the buy point. This is going to shift every time price moves. It's going to shift around. Right about here, we start making money, okay? And so that is 416. Now you might say to yourself, why is that 416? Why do I not start making any money until the price of 416? Well, 408 is the strike you bought, but you paid $8.90 for it. So you paid almost $9. So you have to go all the way up to start making money here, right? So if you buy the 408, you really don't start making money until after price gets above $416 at expiration. That's not exactly true through expiration, and that's what this line says, okay? So the pink line says, all right, this is now though. And see, if you bought it here and price began to move up, you're gonna make money before expiration. See this line right here? This is time. This is the timeline about expiration. That's when these two converge, when the estimated price and the actual price at expiration become the same. But here's the thing, for us in Pro Benzinga on my tab, we don't wait until expiration. We just wait until we start increasing the amount of money we make. And when we've gotten ourselves to a fair profit, 50%, 70%, 100%, whatever it is, then we go, okay, see you later. And we do not hold these to expiration, ever. We just never hold them to expiration. Was that an answer?
Yeah, that answers Pete's question in the chat.
Okay.
So he says, so you can't make your investment early before expiration. So the answer is yes, you can. He says, got it. Great. Makes sense.
So you get it before expiration, but you also get out way before expiration because all you're looking for is movement in price. Now, here's what we want to talk about. Remember, the pink line shows real time, and the cyan line tells us what happens at expiration, okay? So literally price actions got to be above $417 or so before you make any money whatsoever. Any money whatsoever. Now, let's say you want exposure to that 408 strike, but one, you don't want to spend $900 and you want to make money a little bit sooner than it gets to 417. How do you do that? Welcome to the spread. And so as the spread moves up, you're going to see the opposite lines of the put lines. Remember, the put lines gave you something that looked like this. And the call lines are going to give you, this is the put spread right here. The call spread is going to look it's going to be the total opposite. Notice, now down here, you lose $250 as the most you can lose. But look at this. You begin to make money as soon as price action moves. And on expiration, you only need to be magnificently, you only need to be, son of a gun. You only need to be above $4.10. Excuse me, $410. For the other spread, you needed to be at 417 before you actually made a penny. Here, as soon as you get up over 410, you've started making money, even into the expiration date. Now notice, the pink line is also moving up with you, but look at how much faster, when you have a spread, how much faster the spread begins to make money for you versus holding something into expiration. When we hold it into expiration, that amount there uses something called theta that tells you something else is going on, and that is the passage of time that costs money. So the great news is when you buy a spread, it allows you to do three things. It allows you to participate at a strike that would be much more expensive if you had to buy it right out. It allows you to minimize your risk because it costs so much less. And it allows you to make money much quicker at much lower strikes if you're going long, higher strikes if you're going short, than you normally would. So this spread becomes a very powerful tool. So if you're thinking it through, you might go, I hear you, Anne-Marie, but what's the flip side here? What's the flip side? The flip side is you do not have unbounded reward. But here's the thing. We always think about unbounded reward as something that can actually happen. It can't right now. Definitely not in this market space. Price action is not going to move up and over a cliff like you think that it might, because the reason price action has its the reason that price action has its feel or its rhythm is based on how everybody in the market feels. And right now, everybody in the market is nervous, very nervous. And so what we want to do is understand that and say, okay, if everybody's nervous, that means they're going to take their profits very quickly, and price action is going to roll back and give trouble a fair amount. And so what do you want to do? Well, what you want to do is take the spread, because it limits the risk and maximizes the relative reward. All right. Hopefully that makes some sense. It's certainly something that I enjoy a lot. I love doing spreads. They're very, very powerful. Here's one more thing I want to show you. And it's something where we put two verticals together. And when we put two verticals together, they create things called iron condors. And so what an iron condor is the combination of a put spread that goes like this and a call spread that, of course, we can still see goes like this. Okay, So this is an iron condor, right? It's two verticals together. Now you might go, holy cow, that's so weird. But notice this is buying an iron condor. I don't normally buy condors because you can see, let me clear all these drawings. This is a long condor. It's something that I don't really do long condors because of this profile, right? I don't want any big long dips. It's not that much. It's $375, but I don't like ones that look like that. Instead, I'm going to sell it, and you're going to see it's actually the combination of a put formation and a call formation, but it'll give us an opportunity to make money. So let me show you what it looks like. Whoops, mouse, back. All right, so this is a selling of two vertical spreads. Now, when I buy a spread, it gives me, ooh, that's interesting. Why's it got that little weird bump? These have the, oh no, they're both expiring in the same place. We're all good. Just a little bit of mess. All right, so now this tells me if my price stays inside of this space, I can make $375, right? What this means is as long as it stays in this area, remember, this is the zero line, right? This is the zero line. As long as it stays above it, I'm making money. If it goes below it, I've lost money. When I sell a spread, I have the loss that I could incur on this side. That's the put. Excuse me, the call. That's the call side. If price goes down, I will lose on the call side. If it falls onto this side, that means price is moving higher. It goes on. Oh, sorry, it's got my stock sticking out here. That's why this is looking like this. All right. So what that does is give me this area that allows me to make money. And notice again, see how big the spike is into expiration. Once you start getting into expiration, how fast this makes money becomes incredibly quick. So when you see an iron condor, it's going to look a little bit like this. If I want these pieces to be wider, I can change the spread, but that's getting a little too crazy. I don't want to talk about that right now. But this is how an iron condor looks. For those of us that have been working with me on some iron condors, a lot of us said, hey, I put a number of iron condors on in about the early part of May. They're all coming off for great profit right now. We stopped putting them in there because they were just really tough for a lot of people. But really, all they are is two verticals sitting right beside each other. One is on the call side, one is on the put side, so you can make money on both sides. If it goes down a little bit or if it goes up a little bit, you're going to make money. So the iron condor is absolutely fantastic. So that's about it. I want to answer some questions and talk about some charts maybe, and look at some things if we want to, stare down some stuff, whatever we want to do.
Sounds good. Shah was asking, well, Shah stated that's a butterfly, not an iron condor.
No, that's not true. Now,
yeah, and I thought, yeah, so please explain why.
Go back. Let's go back. A butterfly shares the same stripe. Do you see this flat thing up here? Let me show you how a butterfly would look. Okay, so a butterfly would only give us an opportunity on either the call side or the put side. The moment you have calls and puts, it becomes an iron condor. Now, this would be an iron butterfly, for those of us who remember that band from way back in the day. What that means is that it holds the same strike. So this person is noticeably looking at what he sees as the memory of a butterfly, but this is not a butterfly because it's both the call and the put side. And the moment you add calls and puts in the same formation, it becomes a condor. Okay, the specialized condor is called the iron butterfly, and that's where the call strike and the put strike are the same. So let me show you what that would look like. Here is the 409 put. I'm going to make it a 409 call instead of the 408 call, right? At that point, when this opens up again, it's going to be a little wonky because there's more risk on one side than the other. Oops, sorry, wrong one. 409. All right, a little bit wonky because they don't have the same amount of risk. One only has $4 of risk, the other one has $5 of risk. So you're going to see it sort of swivel. It's going to have like this once it resets. But then you'll see, hey, that's an iron butterfly because it's got the point. Now, I'll show you what a regular butterfly looks like in the following way. So I'm going to go over here and we're going to do the put butterfly. And we're going to do the 407, 402, 397 butterfly. See how that says butterfly right there? We're going to go over there to the risk profile. Okay, remember I said one of these has, let's move the butterfly off. Okay, so now I've shifted the vertical here that has the short put. It's going to swivel around just a little bit more simply because it had the butterfly sitting in there. But this is what it will look like. When something looks like this, when it's got both positions on the call and put side, it'll turn into a condor and the risk formation will look like this. Now, let's turn this into the butterfly. Give it a couple of seconds to do its thing. I'm going to turn this off right here. Right? Gosh, I don't think my calculator is doing anything. Turn that off. Maybe I'll turn this off. Yeah.
And for anyone who's brand new to butterflies, your heads are probably spinning. But the takeaway here is that the spreads are what limit your risk. And then as you continue to follow Anne-Marie, different combinations of those spreads will be appropriate for different market conditions. And that's where it really helps to have Anne-Marie's expertise saying, hey, take a look at this market condition. This is why this type of structured trade, it will give you the best bang for your buck while protecting your downside.
Exactly.
Yeah.
So this person who said, hey, that's not an iron condor, that's a butterfly, what they noticed was the shape. And the shape said, hey, that looks like a butterfly. But butterflies, again, only have either calls or puts, right? They can be broken wing butterflies where they can have one more on one side than the other. But for the things that I will share with you we're not going to ever do broken wing butterflies because I do not want to expose your risk in any kind of way that makes your brain feel like it's going to explode. We don't want to do that. We want to get you comfortable with what you're doing. So hat tip to the person who said, hey, that's not an iron condor, that's a butterfly. You were noticing the shape, but shape does not define the butterfly. What defines the butterfly is its composition. And so that the composition defines everything. What your big takeaway here is today, everything we do will be a combination of spreads. We'll go long spreads, we'll go short spreads. We'll jam the spreads together. We'll let them share some strikes where one side is a call and the other side is a put, but they'll share the same spread in the center, or a number of things like that. And you'll be able to understand over time that that really is all we're doing. We're just jamming spreads together in the places that we think are going to be beneficial for us as traders.
Awesome. Awesome. Thank you, Anne-Marie. This is definitely the best lesson I've seen using risk profiles to explain these concepts. And for anyone who needs a recording, if you registered for this webinar, then you should get it automatically. If you did not register and you're just watching publicly, send me an email at jonathan@benzinga.com and I will be sure to get you that recording. Or if you have any other questions about basically the subscription with Benzinga Pro and Anne-Marie, we didn't even talk about that yet, but basically you can follow some of Anne-Marie's trades on Benzinga Pro, and there is a link for 35% off of any of our plans that her services are on. I'll talk more about that later, but basically let me know if you need a recording, and then we're building this body of content, right? So I'll be able to work with my editors. We'll get some nice pictures sprinkled in here and there. And so for members, we'll be doing one or two of these each week, continuing
Yes.
to build that body of knowledge so that you'll have a video library as well as these live sessions with Anne-Marie.
I can't wait. I'm looking forward to it. It's going to be great to have an exchange with folks and then watching these things go live and really getting strength of knowledge in the market. We're learning through a time that is a little bit difficult. And you know what? Fair seas never made great sailors, as they say. And so let's embrace this rough weather and just get after it, because we know when things smoothen out, it'll be a very nice ride back to some really nice places in the market.
Absolutely. One of the earlier questions from Mudra, tuning in from India, is
Awesome.
a Dow target in the month of May. I mean, we all want a crystal ball, right?
Absolutely. Let's take a look. All
Awesome.
right. So to do the Dow, we will use, do we want to do DJX? No, that's, yeah. Okay. So, of course, we have to multiply by, I don't know, what do we multiply by? 100 here to get the, yeah. So let me look at the futures to double check. I'm a big futures gal. So yep, that's correct. DJX. All right. So let's think about what we need to see in order to have a look at what we think the Dow is going to do. So right now, we just started a brand new month, and straight away, we've lost the close of the month. So that's not good. If we breach above the close of the month, the goal is going to be to get to 34,000. If we can't do that, we're going to head back potentially into the low of the last month. So if you're saying to yourself, well, which way is it going to go? Nobody knows. But what you can do is think about what is happening and how traders are looking at price. And so you can see that we are making a series of lower highs and lower lows. Here we have a high and a low, and a lower high and another lower low, and another lower high and another lower low. So what's normally happening if we go low and we bounce? We're going to bounce into a lower high. So where is that lower high? Well, some people say it's right here. I'm really not one of those some people, but some people do think it's right here. I don't. I think it's up here. Now, do I think price action is going to roll over? Yes, I do. I do. We have a lot of malinvestment that needs to work itself out, but I believe the chart is running through one of its up cycles like this, right? See how this goes for a couple of weeks to the north. This one goes 2 weeks down and then 3 weeks up to the north and hangs around there in a big fat mess and then rolls over. Same thing here. People are dying to short it. There's the beginning of the month. And so they want to push it down. Being underneath the monthly close is already bad. However, traders are trying to hold the bottom. This chart right here tells us how many new highs minus new lows we're seeing. Now, this is a daily chart. So in weeks past, what we've seen is this moving downward, meaning a lot more new lows than new highs. But since about, what day might this be? The 11th or so, we've seen more highs than more lows. Now, we still had more lows, but that number is getting smaller. And so for the last 2-3 days, we actually have had more highs, more monthly highs than more monthly lows. So this to me says somebody is trying to buy this bottom. Somebody is trying to buy it up. I think it's a relief rally. And so my thought is the chart heads to 34,000 or it heads back to whatever this number is. Let me see what that low is. Hang on. That low is, 30,600. How do you play something like that? My thought is you go to the edges where you think it ought to be out in the future for the month. So let's just do it. If we look at SPY and we go, hey, no, we're going to use, we're going to use diamonds. No, I hate using diamonds. There's just not enough volume here. But let's say at the end of the month, what day? 30th. Let's do the 30th. Let's say we think it's going to be 34,000, right? You can buy the call flat out. You can do that. There's only one person that's done that today, right? And then you can sell the other call. And instead of exposing yourself to $2 of risk, you expose yourself to 95 cents of risk and still have that strike that you're looking for, right? If you're looking for, if it goes back to 31,000, did I say 31,000? Yeah. Or did I say 30,000? I can't remember. Let me go back. It's like a sieve. 30,600. So let's choose 31, right? 30. Yeah, we'll choose 31. You could have it at 282, and then 5 later, you could sell it for 77 cents on the spread, still exposed to the 310 strike, 305. So your upside is, $4 on, well, that's a quarterly, but that's all right. It's fine. Or 78 cents. And that tells you, hey, I'm going to buy this and it's going to give me $178 of exposure and $4 of upside on one side or the other, right? So if you've got $5 of upside and you've spent 178 bucks, then 178 minus 5 is 322. So you have $322 of upside, $178 of downside, and then you're positioned if the price goes to where it's supposed to, right? And what we would really do is take that off before it gets to expiration, because it would end up building for you into that number. But yeah, there you go. You could certainly do it like that. Your thought is not to say, oh, I know exactly where it's going. Your thought is to say, if it goes here and I'm right, what happens? And if it goes here and I'm wrong, what happens? And is there a way for me to position myself that no matter what happens, I end up making money? And that's really what you want to do.
That's so powerful. Roberto has a good question. I think we might need to save it for another session if we're gonna talk about a potential trade for later this week. Is that okay? Do we still have time to do that, to talk about the potential trade for Thursday or Friday?
So we probably need to see what the spreads look like tomorrow.
Okay.
So for those of us who are already members, you're going to see something in there tomorrow that's going to help us figure out what we're going to do for the rest of the week, because we normally put these spreads on the day before the expiring space. So we'd be looking at a Friday expiration, and then, moving from there.
Okay. So then I guess just stay tuned. If you are already a member, stay tuned tomorrow for a potential trade alert tomorrow. And because it could very well turn out to be another one of these great picks. And Roberto was asking, have you ever considered looking at the volume and open interest on these trades?
Every time. That is a very good commentary there. You do not want to take trades where volume and open interest is very thin, because that means there aren't other people on the other side of that trade for you. And so that's why I stick to very high volume environments. I look for spreads that are in SPY and the Qs and all of those things that have an intense amount of exposure, a lot of people playing around. That's going to be where we sit. So trust me, I definitely watch out for that. It is very important.
Awesome. Is it all right if I go ahead and share my screen and just show them
Oh no, please, I'm going to say goodbye to everybody. Okay. And if while you're working with things, a trade pops up because I see something, then we'll be in the catbird seat.
Fantastic. Thanks again,
right.
Anne-Marie. This
Take
was
care.
Awesome content.
See you later. Bye-bye.
All right. Take care.
Thank you. Bye-bye.
All right. If you're on YouTube, go ahead, smash that like button and hit a subscribe and the notification bell so you can tune in next time with Anne-Marie or any of our other great shows. And what you see in front of me is actually where Anne-Marie posts her trades on Benzinga Pro. So this is pro.benzinga.com. You can get a free 14-day trial, and there is a link that's good for today only for 35% off of the actually any of our plans, annual or monthly. But what I wanted to show you here is inside of Benzinga Pro, we've got this chat room. We have all these other tools for news, scanners, charting, you name it, a bunch of good stuff in here. What I wanted to show you is if you have the chat tool open, which you can open or close through this chat icon in the upper left corner, like close chat, then open chat. And then we have all these different chat rooms, but right here, this is where Anne-Marie is going to be posting those trades. So these spreads that we were talking about today, some of these are shorter term trades like that expire the next day. Others of these might be swing trades that go out a few weeks to a few months, depending on the situation. Chase says, "Why do all the charts look like roller coaster rides?" Um, I mean, you're right. Actually, that'd be a nice little intro video for something. Actually, it reminds me. This will date me a little bit, but we used to make these animations on TI-83 graphing calculators. That's what it reminds me of. But anyways, you can see here that she was posting a trade earlier. When was this? One day ago. Opening trade alert on the SPY. BTO means buy to open. STO means sell to open. She gives you the expiration and the strike prices. She tells you how much it's going to cost or how much you are receiving to your account. If you're paying money, that's debit. If you're receiving money, that's credit. And then the risk is 50% and reward is 100%. So basically, that's saying you would stop out if you lose half of the value of that spread, you would stop out, and then the potential reward is 100%. That's our target on this trade. So she tells you the total cost of the trade is $410. I might even zoom this in a little bit more. I think you guys can see that okay. So the total cost is 410 because she took 5 of these spreads. So it's 5 times the 82-cent debit or $82. So 5 times 82 is 410. That's how you get that. And she's giving you additional context for the trade. Prices are moving quickly, so you can enter one at the current price and perhaps place the others at a limit order of 82 to 85 cents. So yeah, she's giving you opening trade alerts and closing trade alerts, and you can see that this was a closing trade alert on Apple for a 41% profit. And then she's also telling you how to hedge additional trades. So if you're brand new, we understand this is a work in progress. It takes practice to get good at this, but this is how you can be in this for the long run. This is how you keep from being on the phone with me in a few months saying, "Jonathan, I just blew up my account or lost 80% of my account. Can you help me?" This is how you get ahead of the curve and learn how to manage your risk appropriately ahead of time. And we're here to help you each step of the way. And let me know if you have any of our other Benzinga products, whether that's newsletters or the trading school or inner circle chat rooms. And we can include Benzinga Pro if you don't already have that with one of your other subscriptions. There's also this ideas tool here on Benzinga Pro. Anne-Marie does post her ideas in here, but then you get all of these other ideas from Benzinga staff members, as well as our experts that publish some of our stock pick or option pick newsletters like Gianni here, giving you price targets and stop losses and his thesis behind that trade. So you get all this included with Benzinga Pro. And if you have any other questions, go ahead and shoot me an email, give me a call, and I would be happy to help. Yeah, Pete, this was recorded. We'll be sending it out to anyone who registered. And if you didn't register, shoot me an email so I can give you that recording. All right, thanks for being here, everyone. I do want to show really quick. Let's see here if this works. I'm clicking on the checkout page. And I'm dragging this down here. So you guys should be able to see the checkout page now. This is what it'll look like when you click on that link that I posted earlier. So for anyone who doesn't already have a subscription, if you click on the link, it's 35% off of any of these plans. The annual is already discounted 34%. So you get more off of that. So you see it's $912 for the year instead of normally it's $1,404. And that includes all of those other tools with Benzinga Pro. If you go month to month, normally that's $177 a month, and this brings it down to $115 per month. You get these sessions with Anne-Marie 1 or 2 times a week. You get her trades included on Benzinga Pro. And then we have a whole video of tutorials on our help site explaining how to use all of these other tools with your trades. Like personally, I really like this what's moving scanner setup, just so that really quick I can see which stocks are moving in the morning and then immediately see what the charts are looking like and whether there's any news that's causing that volatility in the market. So we do demos on these. We have a world-class support team, and you can always reach out to our team through this blue bubble in the bottom right corner. So don't miss out on that 35% off for our monthly subscriptions or annual subscriptions. And let me know if you have any other questions. All right, anything else for today before we call this a day? And hopefully I'll see all of you in the chat. Thank you, everyone. Thank you, Chase, Roberto, Scott, everyone else in the chat. And I will talk to you soon. All right, take care, everyone. I don't have a closing slide, so I guess I'll just finish it. But have a great day. Take care.